Hello and welcome to a discussion on preparation of financial statements and from the financial statements deriving return on investment and the economic value added. But before we get into that, let us recap. Return on investment will show the profit generating ability and profit distributing ability, and the profit generating ability can be shown by return on total assets or return on capital employed, and the profit distributing ability can be shown by return on equity or the earning per share. However, since all these ROIs depends on financial statements, the usual limitations of financial statements will also be applicable while interpreting the return on investment. The another variations of a profitability indicator is the economic value added, and EVA is a NOPAT minus capital charge, and NOPAT is an adjusted profit or a profit of an unlevered firm and is calculated as a PAT plus interest into 1 minus T plus minus the accounting adjustments. And the capital charge is a capital employed into weighted average cost of capital, and the capital employed is total assets minus non-interest bearing current liabilities plus minus the accounting adjustments, or it can also be determined from the sources side as equity plus long-term debt plus interest bearing current liabilities and plus minus the accounting adjustments, and these accounting adjustments are also called equity equivalents. So it's expected that the EVA addresses some of the limitations of ROI. Let us take an example to understand that. So on 1st April, the business is started with these sources. The company raises this money, they undertake these transactions, and we are required to prepare the financial statements, determine EVA and variations of ROI. So when the business is started, so the capital is 500,000. So capital is a source. The preferred capital, preference capital 200,000, which is also an inflow and a source. They've raised 10% loan, 450. So 10% loan will also appear on a balance sheet, and they've raised 11% short-term loan, which is 200,000. 11% short-term loan will also appear on the sources side. With this sources, they started buying and selling goods, and the sales is given as 750,000. 750,000 is a sales, and entire sales is for cash. The corresponding cost of goods is given as 125,000. At the end of the year, there is an inventory 50,000. So that means the company has purchased goods of 125,000 plus 50,000 and purchases, and they paid the money to that extent. During the period, operating expenses 35,000. So operating expenses 35,000 and operating expenses fully paid, so no liability for operating expense. Plant purchase for 200,000. The cost of the plant is 200,000, so the plant will appear on the balance sheet, and the plant was purchased on 1st December, and let us assume that we paid money for that, so 200,000 paid money. And depreciation is for the period at 20%. So depreciation for the year is 0.20, that is 40%. Depreciation for the month is by 12, and depreciation for 4 months. Depreciation for 4 months is equal to into 4, so 13,333 is a depreciation for the period. and to that extent the value of the asset will reduce, because depreciation is a reduction in the value of the fixed assets. So depreciation for the purpose of taxation is different, but we'll consider that while determining the taxable income. They issued shares of 50,000 shares of 2 at 8, so therefore 50,000 into 2 will be the capital, and 50,000 into 6 is the premium, and to that extent cash goes up, capital goes up. Okay, share capital is an inflow 100,000, and share premium is an inflow 300,000. So as a result, the capital will increase by 100,000, and share premium is also a source on the balance sheet. R&D acquired but amount not paid, so you have a creditor sitting on the balance sheet for R&D, and to that extent there will be an R&D appearing on the balance sheet as an asset. However, R&D is amortized over a period of 10 years, and let us assume it is for the entire year. So the value of R&D by the end of the year will reduce to 90,000 amortized. The rest of the information on market value and of the R&D, market value of unsold stock, because both are higher than the book value, we'll consider them for calculating the economic value added. We'll now charge interest because all expenses taken care. So interest on loan 0.10, interest on short-term loans is 11%, 0.11, and let us assume that entire interest has been paid. So no liability on interest calculated on the respective sources, and interest is paid, so an expense paid, no liability. So we'll find the total expenses. So profit before tax is equal to 499, but to determine the current tax we need to find the taxable income minus the taxable expenses. The taxable expenses are COGS, OPEX, amortization, interest, depreciation, but the depreciation is 100,000 because that's showing depreciation is a 50% for the year, irrespective of the period for which you have used the asset. So the taxable income is 413, so current tax is 123,900, and let us assume that we pay that 123,900. But since the profit before tax is not same as taxable income, there is a need to find the deferred tax, and the deferred tax is arising out of the timing difference. The timing difference here is depreciation, so therefore there is a deferred tax of 26,000. So deferred tax is 26,000, and deferred tax will appear on the balance sheet as a liability. And we have all the sources here and all the payments here. So cash in hand on the date of the closing of the balance sheet is 189, and the entire retained profit will be transferred to the balance sheet, as it's not given whether the profits have been distributed or not. So let us assume that entire profit is retained, and the cash is coming from the cash flow statement. So the balance sheet is ready. So we are required to now find some non-GAAP financial indicators, and one of them is the NOPAT, capital charge. As a result, we can find EVA. As we mentioned here, NOPAT is an adjusted PAT, adjusted for interest and accounting adjustments. So the PAT here is 349. We take interest is 45 plus 22. We add back the interest. Then the tax benefits of that is 20,100, which will be deducted because to that extent you have not taken the benefits of R&D, no amortization. The R&D will go to the impairment, any profits will increase, so R&D will go up by, the increase in R&D will be by 5,000 because the market value of R&D is given as 105. So therefore we are showing that increase as a profit. In the same manner, increase in the stock value, market value of the stock goes up to 62,500. So the increase in this stock will also be adjusted, and deferred tax in EVA calculation is not considered, so the deferred tax is added back. So 450,167 is a net operating profit after tax. In order to prepare the capital charge, it will be useful to prepare an economic balance sheet. The economic balance sheet will show the assets at the near market value or the market value. So therefore the value of inventory will be 62,500. The value of the plant is no change. The value of the plant is 186. The value of R&D for EVA is 10 plus 5. So it's a market value. We can see that in accounting it shows 90,000, but in economic balance sheet is 105,000. Cash in hand, no change, 189,000. So all the items come from the income statement, at the NOPAT adjustments and the balance sheet. So this is an adjusted assets. The adjusted asset comes to 225,267. The corresponding equity is capital plus share premium plus retained profit, 10% preference share, 10% loan, 11% short-term loans, non-interest bearing current liabilities, that is creditor. Okay, non-interest bearing current liabilities is for R&D creditor, and the balance will be treated as the equity equivalent, which is 53,500, and 53,500 is the adjustments for R&D plus deferred tax plus this will give you the equity equivalent. So equity equivalent is the adjustments to convert the accounting balance sheet to economic balance sheet. Now we can calculate the capital charge. So capital charge will take individual sources, or we can take all capital employed and multiply it with WACC. But let us do it with an individual items, and we have, these are the cost bearing funds. We have assumed the cost of capital to be 20%. So this is 20%. The cost of preference share 10%. The cost of the loan is post tax, so 7%, and cost of short-term loan is 7.7%, and equity equivalent once again 20%. So if you multiply the cost into the rate, we'll get the capital charge, and the capital charge is 327,553. So the NOPAT minus capital charge will give you the economic value added. The cost of weighted average cost of capital, weighted average cost of capital is 15%. The return they're getting from that source is 450 divided by this 21%. So therefore the EVA can be calculated either by deducting NOPAT minus capital charge, or EVA can be calculated by deducting the return on capital employed minus the WACC into capital employed. So the balance sheet, income statement and the cash flow statement are GAAP based numbers, whereas the EVA is a non-GAAP. So as a result, the profit shown in the income statement may not be exactly same as this, because this is an adjusted profit and this balance sheet is an adjusted balance sheet for the to make it more closer to, or to make it to reflect the market reality. Thank you very much.